Hey, hey, hey. Hello, everyone. It's your girl, Monica Love, and I am here on the platform of the Exit Strategist 5. And I'm rolling solo today, but that's okay because I have you, right? Right. So today we are going to talk about life insurance and how much do we really need? It is Life Insurance Awareness Month, the month of September. And with this month, we dive into talking about life insurance. Before I go any further, I do want to recognize and acknowledge the exit strategy, the four who are not here today. They had so many things that were going on in their lives that they just weren't able to be present. The one that I do want to give a shout out to in particular is Brandy Gamble. She is the quintessential financial professional, and she has to attend her grandfather's funeral today. So our prayers are with you today, Brandy, and know that you have much love from the Exit Strategy 5. The other ladies also have family things going on, but we hear y'all. We are here. I couldn't help but think about the color purple when she said that in that line, but I digress. So we're talking about life insurance. And one of the things that we really wanted to highlight and focus is how do you know what's enough life insurance? I was speaking with a man last night and he said that he wanted to get life insurance and but he didn't know how much he needed to get, and we had that whole conversation. One thing that I do want to point out concerning life insurance, because it's something that I learned the hard way, which is the life insurance that you have on your job, you do not just take that with you when you leave your job. I thought that I could take it with me. An example is that when I was working with corporate America, I had almost a $2 million policy, and I thought that when I retired or quit or whatever I might have done, I had expected to retire in the few years coming, and I thought that I could take it with me. I had been there for almost 30 years, and so I thought that that would be something that would be able to be a part of my future because I would just pick up the payment for it and have it to take with me. That's not the case. If you look at your life insurance policy, go to your HR department and say, I want to see a copy of my life insurance policy. Read in there, and it will tell you that policy is only valid if something happens to you while you're working. So if you die prematurely, then that is when your family will be able to get the benefits from that policy. Otherwise, that policy does not go with you. You cannot purchase that policy. You'd have to get a policy outside of the company. When we work, those are term policies. So those policies are only temporary, which are during the term of your employment, unless you die during your employment, which is premature death. And we're not looking forward to that, right? We want to be able to retire and move on to the advancement of our lives. Did you know that stats show that only 1 to 2% of people who have term policies, be it inside of work or outside of work, only 1 to 2% of those people actually use the benefits from that term policy. So 98% of people who have those policies never use the benefits because they don't die prematurely. Yay, that's a good thing, right? But we want to make sure that we have a policy outside of work. Um, if you don't have a policy outside of work, this was my experience. When I started with the company, I was in my early 20s, which means that it would have been less expensive for me to get a policy in my early 20s than it was when I actually left almost 30 years later. So over 25 years later, I would have, when I did end up getting a policy, I was getting a policy, and the quotes were based on my then current age. So when you get, the older we get, we're in our 30s, 40s, 50s, 60s, whatever that age is, the more expensive those life insurance policies are. So remember that it is better to get those policies early on. There are some amazing policies that you could take advantage of. And one of the things that we have to remember when we take advantage of policies, I shouldn't say one of the things, I should say some of the things that we have to remember is that life insurance today is not the same as it was, 20, 30 years ago. There are different types of policies that you're able to get, which there's a policy that you can get called the Index Life Universal Policy. That policy, IUL, is what they call it in them streets. That policy allows you to grow wealth. That the cash value is tied to the performance of the index, so that the S&P 500, whatever that performance is, that growth potential is tied to that policy. And your money is not at risk of the market losses. So that's the nice part about that IUL, is that you never have to incur any losses in the market, but you do have an opportunity to take advantage of growth that happens in the market. And that money grows tax-free. Different strategies, that's a whole other conversation. But I do want to point out that inside of that IUL, you do grow that money tax-free, and those tax-free dollars that are accumulating in that account, you are able to take that money out, borrow against those funds that are there. And there is also something that's called flexible premiums, which means that you can do what we call overfund that policy, right? And when you overfund that policy, that money still has an opportunity to grow. Of course, there are limits that are on how much you can overfund, but you do still have the opportunity to overfund to some very great extents. As a matter of fact, as those grow, some people have even taken advantage of that growth and saved it in those accounts, as retirement strategies, not the complete strategy, of course, because you want to make sure that you do different strategies for retirement, not just one. But this is a real opportunity to have monies that's growing for you, that's not subject to the market, that does get tax. You don't have to pay taxes, so it gets tax advantages because of taking opportunity to take advantage of some of the IRC codes, the Internal Revenue codes that were established to benefit people who know about them, right? You can't take benefits of stuff that you don't know about. So you can create legacies for your families right inside of these accounts. But then you can also take advantage of living benefits when you take those monies out while you yet live. You riders onto your policies where you're able to take some of those funds that you have in that account, or even the face value of the death benefit. You could take some of that out while you yet live if you get diagnosed with some chronic or critical illnesses that would qualify. If you're not able to perform 2 of the 6 daily living, you're not able to work, how do you live? Well, but how do you determine exactly how much of a policy you actually need? I'm going to pull up on the screen here what's called the DIME method. The DIME method. And what the DIME method is this is a method that you use in order to establish how much of a life insurance policy you actually need. I mentioned earlier, I was talking with the gentleman who was saying he was trying to figure out how much he actually needs. He has a lady friend, he has children and grandchildren now, and so he wants to make sure that he leaves something for those people. And I'll have this conversation with him. We weren't in a position to have that conversation when we were talking, but we need to establish the DIME, and that'll give him his total amount. That DIME is Mr. Smith, I'll call him. What is your debt? What are your debts? What does that look like? What do you still need to pay off? What is the income that you still need, that you still have, that you want to leave for your family, because maybe they're depending on your income. Maybe you're the breadwinner. Maybe you have, you're responsible for the bulk of the bills in the house, and you don't want to leave that burden on anyone. So what is that income? what is your mortgage? How much do you pay for a mortgage as far as the overall debt for that mortgage? What does that look like? I've even heard the M being defined as mortality. What type of debts do you have, or what type of uh, living benefits do you want to leave for those loved ones? Not just a mortgage, but what other balances do you have in your, if you reach mortality? Say, for instance, we were talking earlier about the living benefits. So what is that living benefit that you would want, because they only allow you a certain percentage? So what monthly income do you want to make sure that you have over and above the regular income that your family would need to depend on for that mortgage, that either mortality or mortgage that you want to place in that balance line? And then you want to know, is there an education that you need to pay for your children in college? Are they getting ready to go to college? Will they be in college? How many kids are there? How many years do they have in school? So you want to make sure that you care for that education. What kind of educational debt do you yet have that you want to make sure is covered? So if you use that dime method, add that all together, whatever that number is, that'll typically give you a number for how much you need to have in life insurance in order to make sure that your family is set and secure should anything happen to you. Right? So if you use that dime method and determine what those numbers look like, then you'll be able to help your family to know what they need to do in order to live a life pretty much equivalent to what they're living while you're yet there with them. You never want to leave a burden on your family, and you also want to make sure that you can take advantage of those living. Honey, listen, those living benefits are the bomb.com, in my opinion, because it allows you to take advantage of monies while you're living, and it allows you to take a burden off of, just think about it. If you have a diagnosis where you have to wonder, oh my God, how am I going to pay my mortgage? I'm going to lose my car, this, and this. Well, if you have a policy that's been created with those living benefits incorporated, well, you would be able to take advantage of that, provided you met the qualifications for those living benefits to be taken advantage of, right? So make sure that you understand what your requirements are. Make sure, because an index life universal policy is not for everybody. I pointed that out because I wanted to have that conversation around accessing that cash, around the growth that happens in the account that's not subject to the market, but yet, well, the losses aren't subject to the market, but yet it is subject to the market as far as the gains are concerned. Of course, there are caps on the gains, so you have to make sure that you care for that. But then there are also the tax benefits. I think I mentioned that you don't have to pay taxes on that growth. Honey, there are just so many benefits contained in the different policies that you're able to take care of. And maybe you do want to take a temporary policy. In addition, you can do some combinations, right? Where you have some permanent policies and some temporary policies coupled together to give your family more benefits while you are paying for a mortgage, for instance. Maybe you want the mortgage piece of it. Maybe you have a $500,000 home. Maybe you want to put that $500,000 in that term so that once that mortgage is paid for, maybe it's just a 20, 30-year term where that mortgage gets paid off and that term drops off, and now you only have to concern yourself with the permanent policy so that it lasts up to age 100, 120, whatever that number is, that it would last for the duration of your life so that your family never has to incur that burden. There are different, I'm going to calculate it, but I do want to make sure that you understand, honey, that the exit strategy is here for you. We are here to give you information, to help you. We go into corporations, into churches. We help Endowments. Maybe a church wants to help their congregation understand what an endowment is, because sometimes church members want to leave their funds, their property, whatever that is, to their church should something happen in their lives, to a nonprofit organization should something happen to their lives. Well, in order to help your congregation understand what that looks like, you need to contact the exit strategy. You need to contact us and let us put a date on the book. There is a calendar that you're able to schedule some time with us when we can speak one-on-one. We can come as a group, we can come individually. All of us have our own businesses outside of the exit strategy. In addition to the exit strategy, we're all licensed, qualified professionals, so that we're able to do what we do. And not only do we do what we do, honey, but we do it with excellence. So make sure you reach out to us. Don't sleep on our book. We have a bestseller. So that bestseller is Design Your Wealth Mindset, where we talk about some practical things as it relates to finances. There is a young lady in that book named Tina who is living life. And quite frankly, when we were writing the book, when we were talking about Tina, I was offended because Tina's life was a lot like mine. And but we had to go through that whole process so that we could come and do better and be better. We talk about being ready, helping people who are ready to elevate to another level. Listen, you better get ready. If you're not ready, you better get ready, because it's time to be ready right now. And if you would send us an email if you have questions, get in our calendar. Our email address, theexitstrategy5@gmail.com. And we are here to help, here to support, here to make sure that even if you're not ready, don't know how to get ready, we will help you get ready to elevate to that next level. My time is up for today, but I am excited to let you know that we're here for you. We appreciate you, and we will help you, but you have to reach out and get the help. Take the step and get the help. All right? All right, y'all. Have a good one, and we'll see you next time on the Exit Strategy 5.